Welcome to the daily update. We'll go over the action in the market for Friday, July 19th, and then we'll see how things look for Monday, July 22nd. We broke below the 20-period simple moving average and exponential moving average. That has now turned the short-term trend to negative. We're still hanging in there with the intermediate term, but we're showing signs of weakness, and some of our intermediate term indicators are starting to turn negative, including our primary indicators. So we have to wonder, are we going to go down now and test the 50-period moving average to get more of a decline rather than just a pullback? So things are switching over and not really looking all that great at the present time. However, on Monday, we do have a positive seasonality day as far as Mondays being the best day of the week. Maybe there'll be some buying that comes in, but after we get through the open on Monday, we'll have to see what is the smart money going to come in and do. Please know that I do have a thing called the SPXInvesting Program. It's still free. It's still wide open. You're free to check it out. There are additional things that I post there that I don't post here. And you have first access to this video, the daily video update, where if you wait until it goes public, it'll be after the close on Monday. So this gives you at least initial access. It's free for right now. I'm probably going to lock that down in August, so be aware of that. The program itself is $97 a month, and I go way beyond even what I'm posting on the website right now. There are courses available. There are supplemental videos. We have back and forth. I'll be doing live classes. So there's a lot more that you can get into at the website. There are links that either talk about the program or can take you to the website in the description. Also, the daily videos, the real foundation of all the different videos that I do. This is the weekend, so I'll be doing all these other videos that are around the outside, but they all tie into the daily video. So let's go back and talk about what happened. We had a pretty flat open. We weren't looking all that negative. We weren't looking necessarily positive, but prices ended up falling below yesterday's low. So that was kind of negative sign number one. And then we ended up chopping below S1 at 5507. So now we're dealing with that 5500 level. And we did find support at 5500, a nice round number. Prices tried to rebound, but then continued to drop back down to 5,500 again, and we closed just under S1. So we're a little bit above 5,500, a little bit under S1. We were down 0.71% on above average volume. Now, it was options expiration day, so that probably explains some of the increase in volume. We are negative now in the short term, positive but weakening in the intermediate term. We're still looking pretty good in the long term for right now. We're going to get another inflation report later this week with the core PCE. We're also going to get the first reading of GDP. So that could be a big thing as well. All right, some comments. There was this technical outage. Apparently CrowdStrike had a flaw in their update, and that worked its way into Microsoft's operating systems all over the world and caused all kinds of problems with airlines and emergency services and so forth. And that's never a good thing either. Mega caps and semiconductors, they still continue to decline. This is where the strength was coming from. Now it's where we're seeing a large part of the weakness. The parabolic SAR for 2 days now has been negative. That's a primary indicator. And we only have the ADX now that's looking overbought, but even it's turning over and starting to look more negative. And I'll show you that chart. We're already oversold when we look at the Stochk RSI and the Force Index. Intermediate term, the ADX is also still extreme, but we're well above that 40 level, but we're dropping below the moving average, and it's now starting to come down. So it's showing a weakening trend. And we're extreme when we look at the VIX based on the RSI 9 period. We've been there for 3 days now. And in the long term, we're still looking positive, extreme positive with our 200 period moving average. No real change here with the scenario. The market is pretty much figuring in that the Fed is going to cut rates in September. The dollar was up and interest rates were up. This also put pressure on stocks. We closed at 4.24% with the 10-year yield after we had been at 4.19%. We're still inverted with the yield curves. The reason I keep watching this is we're watching the employment situation. And once it starts to show some continued weakness, That's when we look at the yield curves going back to being regular again. And that's when we start to do a countdown, so to speak, roughly 5-6 months to see if we're going to go into a recession after that. We're just waiting to see how it plays out. Everybody has an opinion. We're just waiting to see what the charts will tell us. We are still neutral when we look at sentiment. We're coming in at 49 where we had been at 51. We're still positive with our trend because the green line is still on top, but it's really coming down, and another down day or a lack of an update could actually cross over to negative. And the ADX is weakening because it's below its moving average, but it's still above 20. With the down day on Friday, our bias is negative, and I'm still keeping our momentum at mixed to negative. You could probably lean a little bit more to the negative side. So we didn't have any economic reports, so there's no charts to show you there. Isabel Net here. This is put up by Real Investment Advice. And this is where we kind of have to keep an open mind because there could be a positive sign to this chart and there could be a negative sign. We're seeing deviations of earnings either above or below the long-term growth trend. Okay, that's the red line, and that's going up. And that means we're deviating away from the zero level. We're getting a little extreme based on a historical basis of where we typically are when we look at the growth rate. And then we compare that with the Fed funds. Now, the fear here that's being outlined in this particular chart is, you notice back in 2000, everything was going up, including the Fed funds rate. And then the Fed started to cut rates, and then earnings or the growth rate ended up coming down. Well, that was when we had the tech bubble. There's these companies that you only had a .com at the end of your name, and they were going public even though they had never sold anything. There was nothing behind these companies, and they fell apart. And then not long after that, of course, we had the terrorist attack on 9/11. That threw the whole economy into shambles. And so the Fed was really cutting rates. So that was a negative event that happened, and that was bringing down earnings. Then we looked like we were doing better, but then we had the great financial crisis. The Fed started cutting rates and earnings started coming down. That was a bad thing that had happened. And then we had a nice little move up here into about 2018. And this is when the Fed started to taper things off. And then, of course, we hit the COVID plunge, and that's when everything went down. Okay, so typically what this chart is showing is negative things are happening in the economy when the Fed cuts rates. Is that going to be the context of what happens now? At this point, the Fed will cut rates just to kind of stimulate the economy, not necessarily because anything bad is happening. And that may not end up having a negative event, but we want to keep an eye on things. Negative events can happen at any time. And a black swan event, a big event that really impacts the US economy, that could end up coming in at any time, and then change it over to the context of this is why the Fed is cutting rates, is because something bad is happening, instead of just trying to promote growth and help stocks to go higher. Okay, looking at the weekly equity fund flows, a lot of money going into the market right now. The blue bar here is really going up, and we're seeing the 12-week moving average increase as well. So a lot of money's been going in. People are just saying, get into the stock market, get into the stock market, which is probably why we're starting to go down right now. And then bonds only hedge when stocks, they only hedge stocks when inflation is at record lows. And we're still pretty low. It might feel like inflation is up, and it's higher than it's been in 40 years. But historically, it's still not as high as it has been in the past, and it has been coming down. And so we're still seeing where bonds and stocks tend to move together. That's why we do intermarket analysis. And we look at all the time. If stocks are going up, does that mean bonds are going up? If they start going in opposite directions, that could usually mean, as far as price, that can usually mean that maybe the economy is running into problems. Let's say bond prices are going up and stock prices are going down, and that is sustained for a while. That is usually when hedging takes place. Then looking at equity allocation, we're at 62% and going up. This may drop off as we're seeing this recent decline. And then we did have options expiration in Friday's session. They actually expire on Saturday, but this is the last day they could trade. And this just shows you a breakdown of all the different options that will be expiring, and it's 2 trillion when you take it all together. So yeah, that can have a bit of an impact on the market. And then we like to look at these from every once in a while. People love these charts, even though I'm not sure really what they're telling us when we look at them day after day after day. This is if you take Amazon, Apple, Microsoft, Google, and Nvidia, and this is the return going back to late 2023. They're up 41% by themselves, where the S&P is up 19% and the others are up 11% year to date. Only found one interesting chart here. And again, there's a negative and a positive side from this. This is Lance Roberts from Real Investment Advice. And this is just showing that a lot of companies are doing buybacks. And that's usually a very positive thing. But the companies that can really buy back huge amounts of stock are the Magnificent Seven and the real big large caps. And pretty much what Lance is saying here is what happens when those companies stop doing that? So lastly, because he had a number of different tweets that he put out, corporate share buybacks expected to approach $1 trillion and exceed that even more in 2024. It could weigh on current leadership. That is because the largest companies with the cash to execute multi-billion-dollar programs, Apple, Microsoft, Alphabet, Nvidia, they dominate the buybacks. For example, Apple alone will account for over 10% of the buybacks. That's good when they're going in and actually doing the buybacks. What happens when they stop doing that? Is that really going to weigh on things? That's kind of what I feel he's trying to get with this particular tweet. Okay, so we're just not looking really positive right now. We did have a flat open. We tried to go higher, but we never even got up to the daily pivot before quickly going down below the unchanged level. And then we fell below S3, which was the low in Thursday's session. Came down, didn't quite get to S1, tried to bounce. That wasn't working because we're also dealing with this 20-period moving average in here too. We eventually broke down even below S1, then came back above, then went below. See, now we're dealing with 5,500. And we tried to bounce up off of that, only to come down and just close slightly above 5,500. All right, not really an awful lot to show here because most of the action took place during the cash session. And we're seeing now where growth and value are pretty much equal with each other, even though they're on different scales. So the blue line and the red line are pretty much on top of each other and declining. And then we look at the growth to value ratio for the S&P. It actually held up a little bit better. It had really been declining as we were seeing some pressure on the S&P index, but it pretty much went sideways with this ratio in Friday's session. Our end of day chart, growth was down to a little bit more with the large caps. Mid caps, it was down a little bit less, and also less with the small caps. But when we look at our end of day charts, we still are seeing a lot of overall weakness here with small cap growth to value, mid cap growth to value, and even S&P growth to value. So not a lot of confidence with this. We're also seeing that we had been falling down. We were sideways when we look at the two ETFs here, growth to value, but we're still now coming down inside of the rainbow and not really seeing much when we look at discretionary where it was down, staples were up a bit. And so we were breaking out with this ratio, but now we're starting to come back down, even though it ticked up slightly on Friday. We look at risk on versus risk off. We're starting to see this come down as the market has been under pressure. Large cap growth is still above its 50-day moving average, but it has been declining lately. And we look at the ratio between large caps and small caps. It did tick back up a little bit. We're wondering, are the small caps producing another fake out? Didn't look that way, and everybody was talking about it, and everybody was throwing their money into small caps. Well, what's going to be the analysis over the weekend as we've seen some pressure in the small caps lately? The Wilshire also coming off of setting a recent all-time high, but has also been declining, a broad market measure. This is where we're starting to look a little more negative here. This is our intermediate term average directional movement, or ADX. We're falling below the moving average. That means a weakening trend, but we're still above 40, so that's an extreme positive reading. The green line is still on top, but the red line's coming up, and another day or so of things not really improving could see a cross here, and we could actually switch over negative. On the short-term chart, we're doing that right now, also declining with the strength of the trend. The green line and the red line are pretty much on top of each other now. So in the short term, we are switching more negative. And we are above average with volume, but in July and August, we typically will see below average volume for the NYSE as well as the NASDAQ. Sentiment, we're seeing a pickup here with the Ulcer Index as stocks have been under pressure, and the VIX is really shooting up here. With the line chart, we closed much higher, and the bar is just all over the place in Friday's session, but also closing higher. The VIX of the VIX, when we're going down, that means volatility is also picking up. So this chart is also really increasing. And this is what we can see sometimes on a seasonal basis, where we come into July, we bottom out with the VIX, and then it starts to go back up. Right now, it looks like this could be playing out, but we don't know how long that's going to last. And we're also still pretty extreme here with the VIX when we measure this using the RSI based on 9 periods. And the momentum of the VIX continues to be up. We're still above this dashed line when we take a correlation between the VIX and the S&P. That means the market is still nervous right now. So that would be more negative. And we're still just really up at the low end of this red box here, where the market is still expecting some kind of a big move. This hasn't worn off, at least yet. We were flat with the equity put call ratio, kind of strange on a down day, but now we're starting to turn back up with the 5 period, and we're also ticking back up with the 10 period as well. We're going up with this other fear gauge, and we're also going back up with the other fear gauge. So we're seeing pretty much across the board sentiment turning more fearful. When we look at high beta versus low beta, when this is going up, that means the high betas are outperforming. Well, now it's coming back down. That means that the high betas are underperforming and the low betas are actually doing better, which are the more conservative and defensive stocks. We were coming back down to the top end of the range here with the volatility risk premium, but we're starting to tick back up, showing that the risk right now is still quite high. Looking at the advanced decline line, we really dropped off with the new highs, but they still outnumbered the new lows. We're starting to roll over with the 5 period, and we're pretty much flat and could be starting to roll over with the 10 period. This is an internal measure and starting to show some weakness. Also still rolling over, but holding up okay when we look at the advanced decline line based on price and volume. And coming back down when we look at the advanced decline ratio, both in the short and intermediate term. This is now turning negative. Accumulation distribution, a smart money indicator, has now dropped below the moving average, so our boom indicator is turning negative as well. We're negative now for the second day when we look at the Chaikin money flow, and we continue to be negative with the Chaikin oscillator. We tick down, but not necessarily falling apart when we look at the cumulative price for the S&P 500. Yeah, it's coming down both based on price and volume, but not with any real fierce action, at least yet. We are declining when we look at the cumulative NYSE advanced decline line based on price and volume, but still above the moving averages. Also declining, but above the moving average with our regular NYSE advanced decline line. When we look at common stock from the NYSE based on price, we're declining with both price and volume here, but not necessarily falling apart. And we're still positive when we look at the NYSE new highs minus the new lows, but it is coming down after giving quite a positive reading. We're showing weakness here with the advanced decline line studies, but we're still above the moving averages with all the main indexes that we follow. Coming down with the S&P as well as the NYSE advanced decline line. They're pretty much moving in tandem right now with each other. So we're coming down on a short-term basis, but we're still wondering, are we going to come all the way down to the 50-period moving average, which is right now anyway, right about where this S1 level is at. On the bottom, we were above average with volume. We're coming down with our 20, 50, and 200-period moving average study just on the S&P itself. We're extreme negative with the Stochk RSI. We're showing some weakness now with our double and triple exponential moving averages. They're coming down, and the lines are also starting to come down. That's threatening the short-term trend. And we're dropping below the 20-period simple and exponential moving averages here. So the short-term trend has now turned to negative. We're also no longer extreme with the stochastics in the short, intermediate, and we're just dropping below the line here with the long term. So that is no longer extreme positive on any time frame. We're extreme already with the force index. That's negative. And we're dropping below the midpoint with our standard deviations chart. That's turning things more negative. In the intermediate term, we're declining, but still above zero with the balance of power. We're looking more negative here with the go, no go with the lighter shade of blue bars, dropping below the midpoint with the highest high value and starting to head closer to the lowest low value. The TTM squeeze is also looking negative, darker shade of blue and declining. Standard deviation is starting to pick back up. We dropped below the moving average, but now we're starting to turn up as well. And again, this doesn't measure direction. This is measuring speed over the last 10 periods. The ease of movement is declining, but still above zero. The Arun is declining after being extreme positive and is still above zero with the oscillator. We're dropping, but still positive with the S&P McClellan oscillator. So we're still going up, but starting to roll over based on price. And we're actually starting to turn down based on volume. Now, this gave us a few days heads up when it was turning up based on volume. Could it now be giving us some heads up as it's turning down based on volume now? We're still positive with the NYSE McClellan oscillator, but really declining and just barely above zero. So we're still going up with the summation index on the NYSE based on price and volume. The Swenlin trading oscillator, still positive, but declining based on price and volume. We're rolling over with momentum. The PMO is rolling over below its moving average. We're still going up, but rolling over based on price and volume. And we're declining with the PMOs that are rising. The buy signals are starting to turn down, and we're still slightly going up with the PMOs that are above zero. Parabolic SAR, 2 days now with the dots on top, a primary indicator that has now turned negative. We are negative with the Elder's Impulse system for the S&P. Slope, a short-term oscillator, is crossing below its moving average, but it's still above this green line, giving us an extreme reading. Now, you could also suggest a longer-term negative divergence here as the S&P was going up and we were setting a series of lower highs here. Some of that is in the way it's calculated, but then it can also lead to a self-fulfilling prophecy. The MACD is looking more negative and starting to head down with a little bit more speed. So we're looking more negative here in the short term with our oscillators. The intermediate term, we're dropping below the moving averages, to rolling over with the tricks and the KST and starting to turn more negative in the long term. Looking at our double and triple exponential moving average based on 50 periods, dropping below both lines, and now the lines are flat, but could be starting to roll over. So now we have to break out this chart that I haven't shown in quite a while, which is a 50-period simple and exponential moving average. We're still above that. Are we going to come down to this level and see if that ends up providing support? So we've dropped below the 20s. Now we could potentially be coming down to the 50s. The Sean trend meter is declining, but this is encouraging. The bullish percent index is holding up for right now. And we're also ticking down a little bit, but holding up with the NYSE bullish percent index. We're ticking back up, but still negative with the NASDAQ 100 bullish percent index. The money flow ticked back up and is above 50. That's still positive. Or the ultimate oscillator is below 50 and declining. That's negative. And we're seeing some weakness here with the vortex. The green line's coming down, but it's still on top. What we're going to be waiting to see is eventually will the green line cross back below the red line. That would turn things negative. We're coming down to the 50 level with the RSI 14. We've spent most of the recent months above 50, showing good momentum. Are we going to go drop down below 50 and show more negative momentum? We've already been dropping below 50 when we look at the RSI 9. The Copic curve, after trying to turn positive, is now turned back negative. On balance volume is declining, but still above an advancing moving average. The 20-period moving averages are declining after giving us a really positive reading, but now showing some weakness. So we're coming back down to the 69 level here after we saw a nice move up. Is that going to put this up thrust that we've seen before in jeopardy? And we're also declining with those stocks above their 50-day moving averages, declining with the 100 and declining with the 200. Then looking at support and resistance levels here, we're dropping below the 20-period mini rainbow. Sometimes these areas act as support. That doesn't look to be what's happening right now. But we're still looking good on a longer-term basis. This is for the 4th week now. I believe maybe it's the 5th week. I lose count after a while, where we've closed above this R2 level, even though we saw a decline of almost 2% this week. And we're dropping below the 50% extension level with the fib extensions chart. Looking at our charts, looking more negative now, or the Heiken Ashi is showing dark candles. We're still positive, but pointing down with the Kegi chart and the Renko charts, finally waking up and going, oh, something's kind of happening here. I'm going to turn more negative. The 3-line break is also looking more negative. And for the first time in quite a while, we have 3 zeros that were drawn in the point and figure chart, and there's no signal right now. We had been working off a positive signal that was generated in the middle of May. That signal has now gone away, and now we're looking more negative with this chart. Long term, coming down and no longer extreme with the 150, we're still extreme and also declining with the 200. And we're negative in the short term with the S&P, and we're negative with the NASDAQ 100. These are the mega cap stocks. The S&P and the NASDAQ 100 are the two main indexes that have those stocks. When we go across the market, we're negative in the short term with stocks, negative in the short term with commodities and the dollar. We're negative in the intermediate term with commodities and the dollar. We're still negative in the long term with bonds based on price. And guess which sectors ended up being positive? Healthcare and utilities. Now, utilities are typically more defensive. Healthcare is definitely defensive, and all of the other sectors ended up being down, with technology being down the most. And we saw an awful lot of, a little bit of blue and then some red as things were really falling apart here. So it just wasn't a very positive day. And the equal weight and regular S&P 500 index are kind of moving down together. And we didn't really see much of a change in this ratio, as we're seeing more things really decline together. The Dow, after really coming up nicely and setting a new all-time high, has come back down to this R2 level. And the diamonds remain neutral when looking at the Elder's Impulse system, declining and still have more room to go according to this chart. When we look at the NASDAQ, also getting a little bit closer to this pivot level and coming down to the 50-day moving average. Is that going to be where we find some support? Coming down to this pivot point, seeing a matchup of the 50-day moving average. We have bounced off of that before, so we'll be watching that on Monday. We're declining with the QQQs with the Elder's Impulse system. Momentum for the NASDAQ 100 is also negative, dropping below this 38.2% retracement level and now coming down to this 23.6 retracement level as we've been falling with the Qs. And we're below the 20-period moving average and possibly coming down to test the 50-period moving average with the Qs. Small caps, after just going to the moon, well, they kind of turned around and are starting to come back. They're still above this R2 level, and they continue to be neutral with the Elder's Impulse system. When we look at the Russell 2000 small caps, declining with the RSI after giving us an extreme reading. Lots of red bars here with the daily chart, but still above the 50-day moving average. Momentum is positive, but now starting to roll over. The mid caps are also declining and still have a ways to go to get down to this R1 level, but they still remain neutral with the Elder's Impulse system. And we're coming off of recent highs with the total U.S. stock ETF, but still above its 50-day moving average. The staples to tech ratio is starting to go back up. That's a concern if it continues. We want to see this ratio going down to be more positive, meaning that tech is back to outperforming staples. The financial sector coming off of recent highs, but still looking pretty solid there. The dollar is still in a longer-term uptrend. It was up in Friday's session after it had been seeing some weakness. The FANG index has been coming down. We'll watch this too. Are we going to come down to the 50-period moving average? And we look at Amazon, which was down 1/3% and below its 50-day moving average. Apple was up just a little bit and still looking more positive. Microsoft coming back down to its 50-day moving average. Google also dealing with its 50-day moving average. Meta was up a little bit, but not quite back up to its 50-day moving average. NVIDIA is pulling back to its 50-day moving average. And Tesla was down over 4%. But again, we could see a golden cross fairly soon if price stays above both of those moving averages. And Netflix was down 1.5%, dropping back below its 50-day moving average. You take all of that together, and that's what's pressuring both the S&P and the NASDAQ 100. And we're seeing a trailing off here when we look at the S&P with the world index, with the short term, and we're flattening out a bit here with our longer term correlation chart. We were up with the 10-year yield. We were down with the 10-year based on price. This is still encouraging, though. When we do a ratio between home construction and 3 to 7-year bonds, this is still holding up for right now. And then looking at our growth to value ratios, these are not holding up right now. The Qs to S&P, we're declining, but still, if anything, we're looking best with the discretionary to S&P, which has been the weakest for most of 2024. And we're also flat, but still looking weak when we compare large cap growth with large cap value. So the large caps, mid caps, and small caps are just not showing any growth strength right now when compared to value. Coming back down a bit here with the S&P to utilities ratio, we want this to go up to be positive with the S&P. And coming off of a recent reading, but still holding up pretty good here with our 5-day moving average of highs minus the lows across the broad market. And we're still having a tendency to come down from this spike that we're seeing, which often gives support to the S&P, but it hasn't been doing any good lately. And we're also seeing some weakness with our advanced decline ratio based on 19 periods when we look at price and volume, but they're still both above zero. And we're going back up with our staples to S&P ratio. We want this to go down to be more positive with the S&P. And then let's see, here's the Hindenburg-Ullman definition. Feel free to read that. We have not received the confirmation, at least as of yet. Now we're going to get the update for Friday session after Monday session. There's a 1-day lag when this chart is updated. We have until August 20th to get a confirmation signal, and the perma bears are just salivating and waiting and hoping that will happen. Not seeing any kind of signal here with the NASDAQ Hindenburg-Ullman either. So what's our outlook? We're still positive when you take everything together, but the mega caps and the semis, they're under pressure. And so we're trying to ask this question, is this a pullback where we maybe drop 3 to 5%? Now that's my definition. First we have just a pullback, okay? And that's pretty much normal. And you can still do that within the confines of being in a positive trend in the short term. But now we're dropping below that. Okay, is this going to develop into a decline that we see of 5 to 10%? And then after 10% is when they usually have the definition of a correction. So these are pretty loose terms for right now. First, we have just a pullback, and then that could develop into a decline, and then eventually develop into a correction with really loose percentage terms as definitions. We don't have any economic reports coming out on Monday. We want to keep an eye on the geopolitical things. Things may be developing over the weekend when it applies to the U.S. election as to what's happening there. Here's the upcoming economic calendar for the week. We're going to get the first reading of GDP in the latest version there. The big day is going to be on Friday when we get PCE prices, personal income and spending. That's when the core PCE comes out. We're also going to get consumer sentiment. And really nothing in Monday's session. And here's a look at the whole week together. Seasonally, we're neutral to negative with the Dow on July 22nd, and we're neutral to positive with the NASDAQ. So we don't have much of an edge either way. This is going to be the week after options expiration where it's almost 50-50. We're up 51, down 49. So you could flip a coin as far as the seasonality of the week itself. Now, we do see a little bit of positive seasonality here with the green dashed line for Monday's session. But then look what we see after that. I'm not saying that's what's going to happen, but this is historically what has happened, where we might get a little bit of a bump up, and then we go through a few days, at least 2 days of negative seasonality before we might see a little bit of positive seasonality going into the end of the month. And Monday is the most positive day of the week. So we got that going for us. And then looking at this, actually, this is a new one. It says stocks don't like a lame duck election. Good thing 24 isn't one. Well, how do you know? We don't even know what the standing is right now with the election. And this could end up turning into a lame duck election if things change based on what's been happening lately. But if that doesn't change, this tends to be more positive. This is the 4th year of a new president, which may still continue even if the delegate ends up changing, which is kind of interesting, where we see more negativity when it's a lame duck president, meaning that they're finishing out their term. They can't be reelected. And then looking at this, still in that sweet spot for seasonality, but we've been really outperforming right now. We could be seeing a little bit of a reversion back to the mean. And we're wondering, are we past this Santa Claus rally here, I guess you could say, for July? Are we going to see some more weakness now with the NASDAQ? And then we actually see a lot more choppiness during an election year than we usually do during a non-election year. And we're still kind of far away, even though we've been pulling back to get back to the average of what typically happens right about now. We're through the first half of July. Now we're starting to go into the second half of July. So the warning signs, and our list is getting a little bit longer here. Keeping an eye on these defensive sectors, where healthcare and utilities were up on Friday, everything else was down. And we're asking this question: will mega caps and semis, is the selling still going to continue there? Growth to value, discretionary to staples. If anything, discretionary to staples is holding up a little bit better, but the growth to value ratios are not. We're now below the 20 period moving average for the S&P. And then we look at our three main smart money indicators: accumulation distribution, Chaikin money flow, and Chaikin oscillator. They have now all turned negative. Parabolic SAR is negative. Our oscillators are turning negative. The ultimate oscillator, the Kopic curve, are both negative, and we have negative momentum for the NASDAQ 100 and the bullish percent index. Positive side, we're still looking positive when we look at the S&P and NYSE McClellan oscillators, which for right now, based on price, the summation indexes are going up. We want to watch that volume indicator on the S&P. It's already starting to turn down. We're still looking okay when we look at the bullish percent index for the S&P. We're above 50. It's not really screeching to the upside, but it's holding up better. And the Swenlin trading oscillator, it's positive, but it's declining. In our 5 and 10 period, actually, this is incorrect. They're actually starting to go back up. I forgot to change that. Our advanced decline lines are still positive, but declining. The money flow, the vortex is showing weakness, and the money flow is still positive. And the bullish percent index for the NYSE is still positive, but declining there too. And the financial sector is positive. So our conclusion: we're still positive when we take it all together, short, intermediate, and long term. We are turning negative as mega caps and semis are showing weakness. We're looking at possibly, is this still considered to be a pullback, or is this going to develop into an actual decline? In the short term, we're now negative because we're below the 20 period moving averages. Intermediate term, we're still above the 50, but we're showing weakness, and that weakness is developing. Are we actually turning more negative now? We're still positive in the long term because we're well above the 200-day simple moving average. Thank you. I really hope you found this helpful. I hope you have a really good day, and I will talk to you in the next video.